Hi kinds, welcome back to our channel Be Kind. Christmas and New Year are fast approaching and 'tis the season to celebrate this time with your friends and family and take a relaxing holiday. But 'tis also the season to do some smart financial planning so that you can save on taxes. If you're a Canadian, PR, or a citizen, watch this video where we'll cover 24 things that you need to do before December 31st, 2024 to ensure that your tax refunds are maximized and your tax liability is reduced. So watch this video till the end and we'll cover a lot of steps to keep your hard-earned money in your pocket. So let's get started. But before we go into the 24 steps, in case you haven't subscribed to the channel, please hit that subscribe button and like and share this video with your friends and family if you find anything useful. We are putting a lot of effort to make these videos outside of our daily jobs. With your support, we'll be able to grow this channel so that we can devote more time to it. So do hit that subscribe button. And now let's start the video. So first item on the list is to open a brand new FHSA account. If you're planning to buy your first house in Canada in the future, then this is a no-brainer. This account combines the best of TFSA and RRSP benefits. So in case you put any money into your FHSA account, that reduces your taxable income, so you pay less taxes on it upfront, and any capital gains that you make on the investments in FHSA are also tax-free. So open your FHSA account before December 31st to get the full benefit of this year's contribution room of $8,000. So in case you are a couple, you will be getting $16,000 of room if you open your account in this year. So don't wait on this and do this step for sure before December 31st. Second step that you have to do is to maximize your TFSA contribution room. TFSA or tax-free saving accounts allows you to deposit up to $6,500 from your 2024 limit. But if you have not deposited in your TFSA account in the previous years, that unused benefit also carries forward to this year. Investments in your TFSA account continue to grow tax-free, so any gains that you make in TFSA, you will not be taxed on that gain. And your withdrawals are also tax-free, making it one of the most powerful tools in the arsenal to maximize your tax refunds. So calculate your TFSA contribution room depending on when you became a PR or tax resident of Canada. There are ample tools available online. In case you need any more help, please write in the comment section and I will be able to share more links with you. So the third step is to calculate your RRSP contribution limit. There are two ways you can calculate it. You can go to your CRA account and check your limit there, or you can also look at your previous year's tax statement and you would see on that what is your RRSP contribution limit for this year. Contributions to your RRSP account reduce your taxable income, which means that you will be able to save money. So don't leave this on the table and max out your contribution right now. Step 4 is also related to RRSP. Now that you know your limit, contribute to the RRSP account as much as possible. Although technically you have the first 60 days of 2025 to contribute as well, but why to waste time when you can do it before December 31st and give more time for your investments to grow. So max out your RRSP contribution limit, but don't go above and beyond your limit because there are penalties associated with it. So be thorough in calculating your right RRSP limit and contributing to it. Step 5 is to harvest any capital losses. In case you made any investments in this year where you are seeing any notional losses, consider selling those investments before December 31st, and you can use these losses to offset any capital gains that you would have made on any other investments. So this way you don't have to pay taxes on your capital gains if you offset it against a capital loss. Step 6 is to contribute to Spousal RRSP. If you are the highest earner in your family, consider contributing to your spouse's RRSP program, which can split the retirement income and effectively reduce your tax burden as a family together. Step number 7 is to claim charitable donations. Donations to registered charities not only help a great cause, but also provides a great tax credit. So keep your receipts with you if in case you have made any donations, or if you are planning to make any donations till December 31st, keep your receipts and note it down on your 2024 return. Step number 8 is to pay off deductible interest. If you're paying interest on investments or rental properties, consider paying as much as you can before December 31st. This can maximize your deductible interest claim for 2024 and again is a tax saving for you. Step number 9. Contribute to your RESP. If you have kids, then don't miss out on investing in your registered education savings plan. Whatever you contribute to your RESP account, the government will match 20% of it up to $500. So that's free money on the table that you're leaving if you don't invest in your kids' RESP account. Step number 10. Use the Canada Training Credit Program. If you've taken eligible courses this year, you can claim the Canada Training Credit. So go on your CRA account to find out how much you're eligible for and ensure that you're taking the courses which are part of the program. So another way for you to improve your skill set and also save some tax dollars. Let me share a fantastic opportunity that you must make full use of before the end of the year. You can open registered accounts in Canada through which you can save thousands of dollars and get maximum tax refunds. TFSA and RRSP are the first ones that you should open. TFSA is actually the perfect account to grow your wealth because any capital gain made on your TFSA investments are completely tax-free for life. Imagine saving $5,000 for, say, the next 15 years at 6% return. Your investment would grow to $123,000 at the end of those 15 years. But if you would have invested this amount in a regular savings account, you would only make $104,000 in a taxable account. So that's nearly $20,000 that you can gain just because of investing in the TFSA account. And any investment that you make in your RRSP account reduces your taxable wealth by the same amount, thus leading to huge tax savings. Also, you can withdraw money anytime from your RSP account if you're purchasing an eligible home or for further education. If you need to grow your wealth through these two accounts, you will need a brokerage, and let me tell you that Moomoo is the perfect one for newcomers to Canada like us. Moomoo is a well-trusted global stock trading platform designed to make opening and managing TFSA and RRSP accounts very seamless. With low fees and smart investing tools, Moomoo makes it very easy even for a new investor and allows your wealth to grow tax-free. So open your Moomoo account now using the link in the description box. You will get $200 of stock cash coupons and 60 days of trading for free. Make full advantage of this offer using the link in the description. Now let's go back to the video. Step number 11. Prepay your medical expenses. If you have significant medical expenses, consider paying for your procedures, prescriptions, or therapy before year end. Medical expenses increasing 3% of your net income or $2,635, whichever is less, can be claimed for a tax credit. So do some research in case you have any significant medical expenses and make full use of it before the year end. Step number 12. Make a tax installment payment. If you're self-employed or expect to owe some taxes, making an installment payment before December 15th can reduce some interest and penalties. Now, this year's deadline has already passed, but ensure that you keep this in mind for next year so that you'll be able to save some interest and penalties due to late payment. Step number 13. Maximize work from home deductions. If you are working remotely, then consider keeping the receipts of your expenses like internet, utilities, and office supplies. These deductions can reduce your taxable income. So speak to your accountant in case you have a work from home employment, and you may also need to get some forms from your employer. So do some more research if you qualify under this program. Step number 14. Invest in a registered disability savings plan. If you or a family member has a disability, consider contributing to an RDSP. Contributions grow tax-free, and the government may also add matching grants up to $3,500 annually. So take use of it if you or any of your family member is having a disability. Step number 15. Defer your investment income. If you have control over when you want to receive your investment income, defer it till 2025. If you have control on when to receive your investment income, defer it to 2025 so that it can reduce your 2024 taxable income, if that makes sense from a tax saving strategy. Discuss with your accountant if this makes sense for you individually. Step number 16. Split pension income. Pension splitting can reduce income income for retirees. If you're 65 or older, transfer up to 50% of your eligible pension income to a lower income spouse. This can also be a good way to save some tax dollars if you are above 65 years old. Step number 17, maximize union or professional dues. Don't forget to claim any union or professional membership fees that you have paid this year. These expenses are often tax deductible. Discuss with your accountant if this pertains to you. Step number 18, claim moving expenses. If you moved for work or school, expenses like travel, temporary lodging, or storage may be deductible. Make sure that your new move is at least 40 kilometers closer to your work or school. But it's a fantastic way for you to claim some expenses if you moved for your work or school. So do some more research if you've done moving this year. Step number 19, contribute to a TFSA for your spouse. Help your spouse save on their taxes by contributing to their TFSA account. The income from this gift isn't taxable, which can reduce your household tax burden. But ensure that you don't contribute beyond the TFSA contribution limit, otherwise there can be penalties and interest that you would have to pay. Step number 20, claim home accessibility expense. Did you renovate your home for accessibility this year? The home accessibility tax credit allows you to claim up to $20,000 in eligible expenses. So again, discuss this with your accountant if you've done something like this for your home. Step number 21, take advantage of dividend tax credits. If you earn income from Canadian dividends, remember to claim the dividend tax credit. It reduces the effective tax rate on this type of income. Step number 22, contribute to a private health spending account. If you're self-employed or a business owner, a private health spending account allows you to deduct health expenses through your business, thereby reducing your taxable income. Step number 23, review all the income sources available for you. If you have a tax accountant, meet with them before the December year end to ensure that you're not leaving any tax credit or eligible exemption on the line. A financial tax advisor would be the best person for you to reach out and determine for you specifically how best can you save some additional tax dollars. Finally, step number 24, start planning for 2025. Tax planning and tax reduction is an ongoing strategy. The earlier you start, the better prepared you will be for next year's tax season. And now that you have watched the video till this step, let me give you a bonus tip which will help you as you're looking at your tax expenses. Don't be Pennywise, pound foolish. By that I mean don't cut any corners or try to show any expenses which are not genuine in your tax returns, because any such act can put you in the light of CRA, and it would be a very bad thing if something like this happens to you. The CRA can catch anything like this and you will be in a lot of trouble if you try to evade some taxes by doing something which is illegal or in the gray area. So consider discussing with your tax accountant and ensure that you're doing things the right way. So that's it, 24 tax saving strategies and a bonus tip that I wanted to share with you for this year's tax season. In this video, I only covered the basics of these steps, so do more research as you're doing your individual tax planning, but doing these steps can save a lot of dollars for you. So make full use of it before December year end and celebrate Christmas and New Year and holidays with you and your family. So we will see you in the next video. Take care and goodbye.